What's up, guys? Nick here. And in today's video, I'm going to be going over some possible future changes I'll be making with my portfolio. But first, let's see how my portfolio did in the last week. As you can see, the passive income portfolio is now at $45,523.56. And at the beginning of the year in January, I was around 45,200 something. So I'm only up 300 something dollars since the beginning of the year, and we're in the middle of May, so it's been 4.5 months, which is crazy to think about. I had a market loss of $472.85, but thankfully I earned $57.26 in dividends. And going back to what I said, how my portfolio is only up about $300 since the beginning of the year, I'm going to go into my funding history and show you that I've put in $3,715 in 2022, and pretty much all of that is gone. All of that money has been lost to the stock market going down. However, I have gained more shares in the companies that I love, the companies that have been paying those dividends. So that's the bright side. That's what I want to focus on when being a dividend growth investor, is the fact that I've picked up a lot of Texas Instrument stocks, which has it's a great company with great dividend growth. And if we actually go to the 1 month, in just a few days, I'll be earning $8.07 in dividends from Texas Instruments. And that's part of consistently investing in this stock and their high dividend growth rate, which I've shown in many videos. But let's actually go over to the activity. So on May 9th, I received a dividend from MasterCard of 79 cents. And I also deposited my regular $125. And then I had 6 buys, which, as you can see, are Microsoft, MasterCard, Home Depot, Costco, Pepsi, and American Waterworks. And all of these stocks have double-digit or almost double-digit dividend growth. I know Pepsi's around 7%, Microsoft just under 10%, and American Waterworks probably just under 10%. But these other, Costco, Home Depot, and MasterCard, all in the double digits on dividend growth. So I love seeing more money go into those stocks. And then on the 12th, I received a $1.28 dividend from Apple. And I actually think that's the first time they've gone over $1, which is pretty cool to see. And then I received 4 dividends on May 13th, $4.48 from Clorox, $3.40 from Colgate, $1.87 from Costco, and then $6.51 from Realty Income. And I imagine tomorrow I'll be getting my stag dividend of around close to $5. But now going into my portfolio update. So as you can see, I've earned $2,700 in dividends, and my market gain is $3,153.20. I think the highest I've been is in the 6,000s. But so what I'm looking at with the current state of the economy and the market, with inflation really high and with the Fed raising interest rates, I actually think that's going to hurt real estate. And in fact, if we go to the week or even to the month, my real estate stocks are down a lot in the past month. And even if we go the past 3 months, my real estate pie is down to $678.65. However, I do earn the majority of my dividends from my real estate stocks. But as I look at my stocks, when it comes to real estate, I'm thinking in the future, I may sell Blackstone Mortgage Trust because it's a mortgage REIT and mortgages are starting to go down. and they don't really perform as well in a high interest rate environment. And LTC, this is the senior living REIT. I'm actually surprised that they're up. I would have expected their market gain to be down for this year, but that's actually surprising to see they're up. But they're just another stock that I'm iffy on, and I really think that my best REITs are going to be O Realty, FRT, Stag, and then Good. So I'm just thinking about that in the future. But the thing is, with the stocks I own, as long as they can continue to pay me the dividend, I really don't see a need to sell them. It's only if they start cutting the dividends is when I really think that it's time to get rid of them. And then if I look at the passive income portfolio, as I've said, I'm not going to be putting any more money into the quadfecta pie because I want to focus strictly on dividend growth, which brings me to the outliers in my stock portfolio, like Altria Group, let's see, IBM, and 3M. These are all high dividend yield stocks, but they have very low dividend growth rates. I'm pretty sure IBM and 3M both do about 0.6%. And then I think Altria is about in that range of 0.6%. Really low dividend growth rate. It's basically say it's hardly any dividend growth. But these are stocks that I don't know if I'll be holding them long term into the future, just because I don't know if they can sustain their dividend. With IBM, we have to see how they perform with their cloud business. They're doing better, but they were still off on earnings this last quarter. And 3M seems like they're always in a lawsuit. And even though during the pandemic it helped them with selling masks, that's pretty much over. So we just have to see what they're going to do going forward. And then with Altria, they're considered the sin stock. They sell a lot of cigarettes, tobacco products. That's starting to be banned more in other states, other countries. So I'm not sure how they'll be able to perform going into the future. But as far looking at my other stocks, as far as they go, Verizon, it's another one of those higher yield stocks that doesn't have very good growth. Like I don't know how they will perform in the future. So that's another one that I'm watching. But then as far as my other stocks, yeah, there are some of these stocks like Walmart, Colgate, Clorox that don't have high dividend growth, but they're still recession-proof stocks. They're stocks that I believe will stand the test of time. So I don't really have them on my radar to consider selling. And another point I want to make is if we look at my real estate pie, I used to have I used to have my real estate at 30%, maybe even at one point 35%. But as time has gone by, I've wanted to lower the percentage of real estate just so I'm not so heavily dependent on it. And I'm actually considering lowering it from 20% to 10% and then taking that 10% and putting it into SCHD, because SCHD is an ETF. As I've had a video before, they own 100 quality stocks and they have a very great dividend growth rate of 11.98% right now. So that's a stock that I want to get into. And in the future, I might actually make that 50% of my portfolio, if not maybe 40%, just because it's a solid ETF with great companies. The dividend growth is insane. Even if it comes down to 10%, you're looking at your dividend income doubling every 7 years. And next, we can look at my dividend income. As you guys can see, in the month of May, we're halfway through the month, and I have $56.83, which right now, so far for the second quarter, I'm at $246.69. And if you divide that by 3, my current quarterly average income is $82.23. And if we remember, in quarter one, it was $196 and I think 95 cents. I was almost at $197 average for the first 3 months. But this May is going to be a low paying month because both Q yield and RYLD are not paying me a dividend this month. However, they will be paying 2 dividends in June. So May is going to suck when it comes to dividend income, but June is going to be awesome. And in fact, June could beat my March number. So I think June will be a dividend record. And so that's the video for this week. I just wanted to let you guys know what I'm thinking about with my portfolio going into higher inflation and higher interest rates. So don't forget to like this video if you want to see more investing content, and subscribe to the channel and comment down below.